Hey guys, this is Roxann Smithers with Smithers and Ume-Nwagbo, your trusted 360 general counsel, and this is a note from my Legalpad. When I'm working with a client that is starting a new business and they've got so many things to do on their checklist, so many decisions that they have to make, so many tasks that they are tackling. Sometimes they balk as the idea of opening a bank account to that task list and specifically depositing their capitalization funds into that bank account. And they think, oh, the business doesn't have, a lot of money right now. I'm funding everything myself. Why can't I just pay for things out of my personal account? Why do I need to set up a separate bank account? And then I have to take payments in that bank account. What is the point? And I always advise them that it's absolutely critical that you do not do a thing called commingling your funds. That means a mixing up of your personal funds and the funds of your business. And there's some very important reasons why you do not want to commingle your funds. So that's what we're going to talk about today, why you should not commingle those funds. So we're talking about the importance of keeping your personal funds separate from your business funds. And the first reason that you want to do that is you want to make sure that you maintain the financial integrity of your business. Every new business and every new business owner should start off by doing a startup budget. That means understanding, assessing, and calculating how much money you're going to need to actually start up and launch your business. You may also want to have an operating budget, meaning how much money is it going to take every month to run your business. And this is going to help for many reasons, which we can discuss in a different video. But once you understand your startup costs and you understand your operating costs for at least the first 3 to 6 months of your business, you want to then set aside, to the extent you can, whatever funds you are going to utilize to actually start up that business and run that business. That's your investment in your business, your capitalization, whether it's just you, business partners, loans, investments from family and friends. That money should be set aside in a separate bank account so that you can then operate and run the launch of your business and the operations of your business while you're waiting for revenue to start to come in. That will help you really understand the performance of your business. That helps you understand and be clear on how much money it's going to take to start that business. Being clear that you have those funds and that you've dedicated those funds to that task. The second reason that you want to do that is that helps establish that wall between your personal assets and the assets of your business in order to maintain protecting you against liability personally and your assets against liability if there's any action that happens by the business, or vice versa, protecting the business and the business assets in case there's a personal liability or something that happens with you personally. Creditors will not be able to pursue directly those assets of the business in that same manner. When you set up a legal entity, you basically create what's called a corporate veil, a wall between yourself personally and the business. And in order to maintain that veil, you have to then treat that business as a separate entity. And a key part of maintaining that veil is separating the finances of your business from the finances of yourself personally and your home. A third reason that you want to consider this, and you want to make sure that you do not commingle funds, is if you are ever looking for an investor, if you are looking for loans, you're looking for third-party funding. That third party or that investor or that loan officer is going to want to see the financial reports for your business. They're going to want to understand how cash is flowing in your business. What are the expenses of the business? What are the revenues of the business? What's sort of the financial life of the business and the integrity of the business? And if you are using your personal account and personal funds and other sources of funds are mixed with the business funds, or if business funds are mixed in with your personal funds, it's hard, one, for an investor to really understand the flow of the business and the financials of the business, as well as there may be concerns about how the business is being run and that financial integrity, and whether or not that investment, that loan, or any other type of cash infusion into your business will be used for the benefit of the business or will be used for the benefit of you personally. Investors are going to be very wary of seeing expenses that are personal coming out of the business account, or funds moving back and forth between your personal account and your business account. And so the ways in which you want to make sure that you are not commingling funds, practically speaking, you're going to want to have a separate bank account for the business that's in the name of the business. And then you have to actually use that account. Put funds into the account when you figure out your startup budget and your operating budget, so that those funds can be used to pay the expenses of the business. Make sure that as revenue is coming into your business, either through automated sales or individual payments from customer or clients, that those payments are made out to the business and that those payments are paid directly into the business bank account. If you decide to use credit cards or debit cards, make sure you get those in the name of the business and that they are used exclusively for the operating and expenses of that business. Then within your records, you want to make sure that you're keeping proper track and categorizing any instances in which you actually infuse funds into your business. So whether that's reimbursable expenses, if you take a client out for a lunch, if you make a purchase on behalf of the business and you end up using your personal funds, or if you're getting reimbursed for mileage or gas for driving and using your vehicle for the benefit of the business. Make sure that you're tracking those as either a reimbursable expense to you from the business, a loan that you're giving to the business, and that at some point the business is going to have to pay back to you, or if that's going to be considered an investment or a capital contribution into the business that's going to stay in the business for a certain amount of time, if not the life of the business, in the capital account. Finally, you do want to make sure that you're tracking any funds that you pull out of the business and give to yourself, whether you're categorized as a disbursement, if it's a partnership or an LLC, if it's categorized as a salary that's being paid to you for working in the business, or if it's categorized as a profit payment. You want to make sure that you're keeping track and properly allocating any money that you're pulling out of the business and giving to yourself. These are 3 ways that you will make sure that you do not commingle funds, that you maintain the financial integrity of your business, that you make it easy for you to attract investors or third-party funding, and you continue to maintain that corporate veil that protects you and your business from personal liability and protects your personal assets from any liabilities associated with your business. So for more information from the attorneys at Smithers and Ume-Nwagbo, you can find us at stulawgroup.com. You can friend us on Facebook, follow us on LinkedIn as well. Please be sure to like and subscribe to this channel so that you can always get the latest notes from my Legalpad.